Two of the world's closest allies just declared economic war. On one side, 50% tariffs. On the other, dollar-for-dollar retaliation. But the real story is not the numbers. It is who actually comes out ahead. The United States hit roughly $20 billion of Canadian goods. Canada matched it with tariffs on American steel, dairy, appliances, and farm equipment. Only about 5% of total trade is directly targeted so far. Yet the damage will not be equal. Canada sends nearly 3/4 of its exports to the United States. Those shipments equal roughly 17% of Canada's entire economy. American exports to Canada, about 1% of U.S. GDP. Economists estimate nearly 90,000 Canadian jobs could disappear if the tariffs stick. Ontario and Quebec face the heaviest blow. Manufacturing hubs sit directly in the crossfire. American consumers will feel it too. Higher steel and aluminum costs feed into cars, construction, and appliances. Dairy and seafood prices rise on both sides of the border. Small Canadian exporters already warn some businesses may not survive. Meanwhile, a quiet winter is watching. Mexico has avoided direct retaliation and is expanding its share of the American market. While Canada and the United States fight, Mexico consolidates its advantage inside the same trade agreement. The auto sector hangs in the balance. Trump has already threatened 50% tariffs on Canadian cars and trucks starting in 2027. That single move would hit one of the most integrated supply chains on the planet. American automakers would pay more. Canadian plants would face existential pressure. Energy remains mostly untouched for now. That exemption shows both sides still need each other. Canada has prepared a $7.5 billion support package, loans and assistance for businesses and workers hit by the tariffs. But support packages cannot replace lost markets forever. The deeper cost is uncertainty. Companies on both sides are delaying decisions. Hiring slows. Capital spending freezes. Trust between the two countries is now scarred. For decades, this relationship delivered predictable growth. Today, it delivers risk. American manufacturers in metals and machinery face higher input costs. Canadian manufacturers lose their largest customer. Consumers in both countries pay more for everyday goods. The only clear near-term winner is the country that stayed out of the fight. Mexico is absorbing market share while its northern partners bleed. If the dispute escalates further, the losses multiply. Canada could tip toward recession. American inflation edges higher. The tariff war is still young, yet the pattern is already clear. Size and market power favor the United States in pure economic terms. But integrated supply chains mean both sides absorb real pain, and a third player is quietly collecting the spoils. The question is no longer whether someone loses. The question is how long both sides are willing to keep losing. Because in this war, the final winner may not be either combatant,